Welcome back to Wealth Mavericks, the podcast where we help doctors unlock the secrets to building generational wealth. And today, we're talking about the difference between your marginal and effective tax rate.
It's money that you are paying taxes on that you don't need to live your life. And that's where planning comes in.
When you're doing tax planning, you're affecting first that top dollar, your last dollar earned.
Hey everybody, welcome back. Today we're talking about the difference between your marginal tax rate and your effective rate, and why the more you earn, the more this matters. So we talk a lot about how we help people recover dollars from the IRS and put those dollars into assets. Where do we put those? What are the rates of return? But today we're going to talk about that return you get on your dollars before you even invest, if you plan correctly. So, Bob, would you say most people we work with know the difference between effective and marginal rate?
I would say most people in general don't know. I didn't know until I looked into it and I started researching more and more about taxes and understand what's this progressive tax system mean? What does a marginal tax or what's a tax bracket mean? And starting to look at it and the history of it as well. And so I have some thoughts and opinions as to when what that'll look like here moving into the future as well. But no, to answer your question, I don't think most people even know. And I would include other professional advisors. Tax preparers, CPAs, enrolled agents, they'll know that. But I don't think the rest will.
So before we get into the conversation about getting that high rate of return as a high earner, can you just quickly give us what is the difference?
I want to start somewhere else first, if it's all right, because it has a huge impact in people's mindsets. Bob, I didn't know any of this until you explained it to me. So it took you a while to learn it, took me a while to learn it, but I learned it from you. And one of the most common things that people think, and this is how it shapes the real world experience, is they go, oh, if I make this much more money, I'm then going to be in this new tax bracket and it's going to cost me all this money. Right? Is that not a very common thing that we hear from people? Right? If I make another $10,000, I'm now going to be in this tax bracket. And that's not true. And until I learned that from you, Bob, that was my mindset as well. And so I think people need to understand, and we've heard that, you guys have both heard that from doctors where they've had tax advisors tell them, oh, you should work less so that you're not taxed as much. And I'm like, is that something that literally even the tax industry doesn't actually understand, or what's going on there? So I can't wait for you to explain this, because it will shift people's mindset around making more money.
Mm-hmm.
Yeah. So I guess the best thing to do before we start talking and breaking down what's an effective and what's a marginal is talk about what is a progressive tax system. What is the tax brackets made up of? So in back in the Clinton era, so let's go back into history, is when they really designed kind of the current level of tax brackets. And what that means is that if you earn a certain amount of money in these two ranges, so a start and an end, that amount of money is taxed at that percentage. So for example, let's say I make $22,000 a year. Well, I'm going to be in the 10% tax bracket. Anywhere from 0 to 22,000 is taxed at 10%. So let's say all of a sudden I double my income the next year and I'm making 44,000, which knuckle bump, that's awesome. Doubling your income is awesome, right? Most would say, well, 44,000 and income's not awesome. But anyways, that's the difference between percentages and real numbers. That's a different episode. So that first 22,000 is still taxed at 10%. The next 22,000 is now taxed in the next bracket, which is 12%. So in the progressive tax system, you have 10%, 12%, 22%, 24%, 32%, 35%, and the top income earners making over the amount at the end of 35 will be paying 37% for every dollar above that amount. So,
and those change over time, right? So it's not set forever.
So the income amount in each ranges adjusts annually based on cost of living adjustments that the IRS makes. Okay. So each year they'll come out and say, oh, new tax brackets, but the bracket percentages are the same and have been pretty much the same until there is a law change, a change in the tax system. Now, the reason why I went back to what's his name?
Clinton era.
Clinton. Freudian memory block. Went back to Bill Clinton, is the system has pretty much been very similar to now. And what I think is the IRS has found their sweet spot. And what I mean by the sweet spot, there's certain brackets and income levels that the majority of people fall into. And a lot of this is perception. And this is where it goes back to the effective tax rate versus marginal rate. So your marginal rate is the last dollar you're earning, what bracket that's in. So if I'm making $1 million a year, well, I happen to be in a 37% tax bracket marginally. Okay, so that's the marginal rate. If I'm making less than that, whatever that amount end is, that is my last area or bracket that I'm in. That's the marginal. Effective, I don't know why I had a high-pitched voice there.
Really exciting.
The effective is your taxes on your first dollar earned, so that 10% bracket, all the way to your last dollar earned. So if it's in a 35 or 37%, and it's the taxation in each of those, that's your effective rate. So that's usually the rate where, like, if you ever go to your CPA and say, Mr. or Mrs. CPA, what's my tax rate? They're going to give you the effective. So they're going to say, oh, it's 24.2. Doesn't mean you're in a 24% marginal rate. It means you're actually in a higher marginal rate. Your overall tax rate is 24%. What were you going to say, Joe?
Meaning it's like blended. It's the blended rate of each of those tranches of money.
Correct. So that's why I'm saying. So go ahead.
Oh, sorry, Bob. Quick question. I'm wondering, so for people who go to their CPAs, why are they getting told one rate versus the other? Is there any reasoning behind that?
They're not getting told one rate or another. They're getting told the effective rate, because that truly is their tax rate, right? That's what they're asking, and that's what the CPA is translating them to. Boom. Because the CPA is not doing tax planning. They're not looking at ways to effectively bring their tax rate down to the lower marginal bracket that they may be in. So this is why sometimes, some of our docs that was brought up previously will say, well, when I complain about the amount of taxes I pay, some of the CPAs will say, well, just make less money. Well, duh.
Right? Yeah, it's like that doesn't work. And I think this is really interesting, Bob, because I think most CPAs, if you look at just most CPAs on average, they are not working with what we'll call high income earners. They're working with your traditional American family who is living, their income is right here and their expenses are right here. They have very little extra dollars to do anything with. And so that's why they don't feel like there's anything that they can do. Whereas we work exclusively with very high income earners who do not live at their, up to their means. So those dollars that are in between what they earn and what they live, that's really what I've heard you say this a million times, Bob. It's money that you are paying taxes on that you don't need to live your life. And that's where planning comes in. I don't think they have those clients, so they don't really know what to do with this.
Yeah. I agree with that. And, the interesting thing from my experience is in going this process, and this is my evolution of education and realizing that growing up in the financial planning world, so to speak, and then hearing what clients talk about taxes, that there was always kind of a misunderstanding. And so that's what drove me to learn about this, is that when you look at, and what I was saying earlier about sweet spots, and why I actually think the tax brackets are going to stay like this moving forward for a long period of time. And the reason being is that most middle-class Americans are in an anywhere from a 15 to a 22% effective rate. So when you hear on the media, tax rates are high, I'm paying a lot of taxes, and then you call your CPA and they say you're in a 19% tax bracket, you're like, oh, okay, I'm good. Not that the CPA is manipulating them or trying to take a political aspect, but the system knows the psychology of where we're at. So when you look at the tax system, and this is where financial planners and financial advisors and tax professionals kind of do a little manipulation. And this is something I did when I was a financial planner. We would always talk about, well, Mr. and Mrs. Doctor, do you think taxes in the future are going to go up? Well, everybody says yes. So what does that actually mean? Well, when we go back to history, we go back and say, oh, well, when taxes first came about, they were as high as 91%. Taxes aren't going to go to 91%. But that was on the top. And that was anybody in the early turn of the century of 1900 that was making $1 million or more. How many Americans were doing that? Right? So that was the wealthy getting taxed more, right? In the Reagan administration, the top was about 55, 57% federally. There was like 3 brackets. Most Americans fit in that. When I say most Americans, I mean like the 90% of Americans were paying half of their money in taxes. And they hit that top rate. So going into this current tax system from Clinton to now and having the breaking, psychologically, we as taxpayers don't realize what's really happening with taxes. And this is where inflation is so vital and important when they call it the silent tax, okay? Is because when we make money, that's how we're paying taxes based on our taxable income. Okay, so let's say my taxable income puts me into a, let's say the 24% tax bracket. And I'm kind of teetering on the 24 to 32% tax. Okay, I'm in 24, but if I made another 10 grand, I'd be in 32, meaning every dollar above that would be at 32 until I hit the next rate, right? So what do? Well, nothing. I just earned my income. But here's what happens. What's inflation? The cost of living increases, right? So when I'm in a higher inflationary period, when I say higher, I mean above the Fed goal. The Fed goal is 2%. Okay. So if I'm in a 3 or a 5% inflationary period, my cost of living goes up. So what do we negotiate when an employee negotiation? If you're barely getting by, you're looking for more money. Right? And if you don't get more money from your employer, what do? Go find one that will pay you for your value. That now all of a sudden your income's higher. Why did your income go higher? Because your expenses went higher. So expenses in the normal average public, the expenses drive income, which pushes people in a higher tax bracket, which increases taxes, which is why most people feel like they're not getting ahead. Okay, so when you fast forward to your point, Joe, and you have folks that are wealthier, they have a lot more discretionary income. They're in a 35, 37% marginal rate. They're living off of enough money that would normally put them in a 24% tax bracket, but all that extra income, they're being taxed on to the point where we talk about that you don't need. Now, we're not saying don't make that money. We're just saying your necessity, your expenses. Again, what was I saying? Your expenses drive your income. So if you have a group of people who their expenses have to go up significantly to drive their income higher, then yeah, that would be an issue. But right now they have a large group of what we call discretionary income, the gap between the expenses and what they actually make. Okay.
And if I were to break this down for just kind of like the common brain to understand, the illustration that makes most sense to me is like, think of your income like a bucket, like imagine a bucket. And at the bottom of the bucket, it's actually sealed up because we have the standard deductions that basically cover that first tranche of money. So essentially, you're not going to pay taxes on that bottom part. So the bottom of the bucket, there's no holes in it. But then when you go up a little bit higher and you continue to fill it, there's a small hole that leaks as you pour it in. That's the taxes going out. And then when the bucket gets filled even higher, there's another hole. When you hit that next bracket, there's another hole that's a bigger hole, right? The percentage is bigger. There's a bigger hole until you fill the whole bucket up. And at a certain point, you have the largest hole towards the top, which is that 37%. And we're not even talking about like the state taxes that are on top of this as well. So depending on what state you live on, there are other holes that might exist. But that's, I think, the frustration of most high income earners is the more you pour in, meaning my life's work and what I'm yielding from that. So I get more education, I become a specialist in this, and I take on a second job. That's you pouring into the top. And the higher you fill that, the reason you feel so frustrated is that more is leaking out because you filled that bucket more. Now, if you also take the bottom of the bucket, there is a hole, and that is your lifestyle expenses. So what it costs you to live your life, that is fully in your control. Well, to the most part, it's in your control. So I just think that illustration in my mind, like, makes it make sense, where it's just, yes, the more you fill that, the more is going to leak out. But it doesn't mean that the hole at the bottom all of a sudden becomes gigantic because you hit that next level of the bucket.
No. Yeah. That amount of income is always going to be taxed at that, right? So one of the things we show people to give them a visual when they go through our discovery process is we show the tax bracket, and then we show the taxes that they have paid in each of those brackets. So when they hit a 37% tax bracket, we're showing that amount taxes, so they can visually see the amount of taxes that they're paying. So if all of a sudden they stop earning income and they go from the 37 down to the 32, well, they're still going to have to pay all that taxes below it. So what do? They hurt their discretionary gap. And so I think a lot of times we think taxes are eating away at all of our money. No, it's eating away at your discretionary. So this is where tax planning comes into play. When you're doing tax planning, you're affecting first that top dollar, your last dollar earned. So it brings to your point, Joe, about the bucket, it brings your taxable income lower. So therefore your taxes on that taxable income lower. Does that mean your income's lower? No. It just means through tax planning, your discretionary is funneled into other areas to build wealth. And that's what the tax code allows. That's what accounting guidelines allow. And there's certain assets that are out there that the government provides have the tax benefits. So most people aren't affecting their right assets. They're in the wrong assets because those assets are what's creating the income that's being taxed at the rate they're at. So having a logical dialogue and a very specific conversation about what people's assets look like, how they're titled and positioned, is dependent on the taxes, which affects their marginal and their effective, as well as the accumulation of wealth.
That's one of the early conversations that we have with our members is, what's the purpose of each, like every single one of your assets? We put it all on one page, and our coaches have a conversation about what's the purpose of this. Bob, we were on with one of the members, and it kind of occurred to me like the power of this conversation. So they had a bunch of assets that were yielding income to them. They don't need more income. They literally, income is their problem, not the solution.
Right.
And so you've got to build, and that's a lot of what you do, Bob, for our members, is really analyze, where can we create more cash flow? Where can we create the right kind of wealth building tool? And that's where I think doctors listening to this probably feel frustrated. They're like, my advisor has never even talked with me about this. Yes, I have all this income that I earn, and then my assets are providing more income that's just being taxed higher.
Yeah.
So you should feel frustrated, doctor, that your current team is not, they just aren't processing these thoughts for you. And you need to look at things differently.
And I think an important distinction to be made with these people who are earning so much and then paying six figures plus every year in taxes is that they are paying 37% on those last dollars, meaning that they're taking home 63 cents of each of those. Then they're putting that into an investment and getting, 10%. 12%, whatever, but you're getting that return on 63 cents. With tax planning, you get the return on a dollar. So if you're not paying the taxes, the initial return is 37%, right? And then you get a return on the investment. So Bob, that's, I think what you say is like the beauty of compound tax savings.
Yes. Yes.
Okay.
And that 63 cents that you said we're putting in other assets and investing, depending on how that's structured, is dependent if that's going to be taxed as well.
Right.
Right?
Exactly.
So you have this layering of taxes, which is so important to understand the structure of your asset, why you have what you have. And the reality is, and this is so exciting, I've got goosebumps, because this is education and reality of your hard work just fizzling away. Giving your time away from your family and your friends to go serve your community as a physician, you get compensated for that, and it's just oozing out the back door, right? Doors wide open and just going right out that door. And so what we're saying is that, you know what, the reality is you don't need income. To Joe's point, income is taxable. What you need is cash flow. So when you go and hear about other people talking about investments, they always talk about positive cash flow, passive income. You, Doc, don't need that. You need value. You need appreciation. Those aren't taxable. Income is taxable. Value appreciation is not taxable until you make a liquidity event, a decision on that asset. And the tax code has specific guidelines on how you can exit that in a tax efficient way. So you can even lower your taxes on that. So there's a huge difference. And this is why we talk about the business of you. The business of you focusing your harder, you are in business, doc, whether you're a W-2 doc and you're working at a hospital earning a great W-2 income. Oh, I'm just an employee. No, this is your business. Your business is your specialty. That hospital's paying you for your business of expertise, and you're generating that. They're choosing to pay you a certain way, W-2 income, and that's how the taxes are being designed. But this is your business. And right now, your business is very tax inefficient. In a business, you got to manage expenses. And when you manage expenses and you lower expenses, you have more profit. And right now, your profit is going out the back door. And that is the focus, and that's where the tax is. If you have value, the tax bracket is taxable income. It's for income. That's what's taxed. So if you do planning, you could actually have less taxable income, but it doesn't have an effect on your lifestyle.
Right.
Okay. And that is the difference. And I don't think CPAs teach that, because I don't think a lot of CPAs understand that. I was just having a conversation this morning with an accountant, and it was a great conversation. And this is an accountant getting their doctorate in accounting. So going through these classes of accounting and finance, and we're talking about what we do and how we do what we do. And I explained to them what we do with our members and how we do it, and the thought process of value in a business, creating value versus revenue versus profit and income. And they're like, Bob, you literally just spent a half hour teaching me everything I'm learning in my doctorate that I didn't understand, that you made it in real world language of how now I understand. And that was kind of like, I was like, oh, sure. I was just not thinking anything of it. But after a while, it kind of set in. I'm like, that's the problem.
Right.
That's the problem, is that we're not learning what we're being taught. We're not being taught what we should learn. It's just like going in on surface level.
Doctors can relate to this. It's like when you as a doctor, all of a sudden you get exposed to some new information. There's new research that comes out, and all of a sudden you learn that and you know that, and you're like, how does the rest of the doctoring world not know this? Like, how did it take me this long to learn that? So we're just having those parallel learnings, as we go. And I think the main thing that doctors need to take away from this is there is something that you can do about it. Your marginal and effective rates really do matter. That's a good question to take to your CPA. When they tell you your tax rate, ask them, is that the effective or is that the marginal? Ask them what your marginal tax rate is. And that's the calculation. Again, it's money that you're taking as income that you don't need, that you're paying the highest taxes on. That's the number that really matters to you, Doc.
And Joe, back to Bob's point, and you've said this to me so many times, for a lot of doctors, they have outgrown their current CPA because their current CPA doesn't have that knowledge or repertoire of information that is so necessary to execute tax savings. What a lot of our doctors don't know when they meet us is that, the IRS incentivizes opportunities that they're already investing into. But it comes down to the structure of how they're investing into these things, the way and the nuances of the IRS tax code. And their current CPA might not understand some of those nuances and specifics. It takes that next level of education, which is where a true tax strategist can come in and make that difference for them.
And that's why it's called the asset and tax team at Terra Firma, because your assets, we've all heard Bob say this before, your assets dictate so much for you. So the taxes are a byproduct of what you have. And so start with that. And you're right, most of these doctors have outgrown their CPA because their CPA just doesn't work with other doctors. That you are an anomaly in their world. And so you got to have a team that's appropriate for the level that you're at.
And it's harder to find a tax strategist than an accountant. We have that conversation all the time. But if you're listening to this, you found us, so problem solved.
Click the link below.
Yeah.
Click the link below. Okay, thank you so much. We're so glad you joined us, Doc. If you like this, hit the subscribe button, join us next time. And until then, go be a wealth maverick.